Okay, let's get right into it. Have you ever been watching a stock chart just take off like a rocket, only to see it suddenly take a nosedive? And you're sitting there wondering, is that a giant red flag or is that a golden ticket? Well, today we're unlocking a high-speed, high-stakes strategy right out of the momentum trading playbook, the art of buying the dip. But hang on. Before we go any further, we need to get one thing crystal clear. This is not a get-rich-quick scheme. It is a high-discipline, high-risk endeavor. The strategy we're about to break down, it's the same one a trader used to turn an account with just over $500 into more than $9.5 million. But that comes with a huge disclaimer. Trading is risky. Most day traders actually lose money. So the rules are simple. If you can't make money in a simulator, you do not trade with real money, period. And you never, ever blindly follow someone else's trades. So, what is the core idea here? We really have to reset our brains from that traditional buy and hold way of thinking. This is all about trading momentum, not value. And trust me, that is a world of difference. Yeah, this really says it all, doesn't it? Traditional investing, that's a marathon. It's slow, it's steady. You're looking for value over years. But momentum trading? Nope, that's a sprint. We're actively hunting for volatility. We're looking for stocks that are moving up fast. And the second that upward movement stalls and the stock starts going sideways, we're out. No hesitation, no questions asked. And that brings us to the heart of it all, the dip. So what is it exactly? Well, it's buying a really strong, fast-moving stock during a moment of, and this is key, temporary weakness. The whole objective is what the pros call catching the spring. Think about it. You're compressing a spring, right? You're trying to get in at that exact point of maximum tension just before it explodes back up. That's the entire goal.
Okay, so if you want to catch that spring, you can't just be guessing. You need a very specific set of tools. So let's open up the tactical toolkit and look at the essential indicators you're going to need to navigate these, frankly, chaotic charts.
First up, we've got VWAP. That stands for Volume Weighted Average Price. You can think of this as the holy grail of support. It's this dynamic line on the chart, and for our purposes, it's the primary line in the sand. If a stock is trading above its VWAP, we see that as bullish, and that's exactly where we're looking to buy the bounces.
Next up, psych levels, psychological levels. These are kind of like hidden support and resistance zones that you won't see drawn on a chart. They just exist at whole dollar and half dollar marks. Think $10, $10.50, $11. Why? It's simple human nature. Both people and trading algorithms naturally place their orders at these clean numbers, and that creates these invisible walls or floors in the price.
And the last tool in the kit is level 2. This shows us the market depth. It really gives us a peek behind the curtain at the real-time supply and demand. What we're doing here is looking for the big buyers. We're trying to spot large orders that are stacking up on the bid side. So if a stock is dipping down to a support level, and you see a huge bid on level 2 right at that price, that's some powerful confirmation right there.
All right, so we've got the philosophy and we've got the tools. Now for the fun part, the how. We are going to break down the 3 core plays for buying the dip, pulled straight from the playbook. Okay, setup number 1 is the dip off support. This is the bread and butter. It's the most common play. The scene is this. A stock is in a strong uptrend, but it's just taking a little breather. It's resting, not crashing. This is our chance to look for things like a VWAP bounce or a double bottom, because that predictable support allows for a really tight, low-risk entry. And let's see this in action. Check out this case study on the ticker WFU. The stock was already flying, up 45% on huge volume. Then it pulls back right to the VWAP, which was conveniently sitting right near the $12 psych level. The entry was made right there, risking only about 8 cents a share. And when the stock confirmed the bounce and retook that $12 level, more shares were added into strength. Just a textbook execution. All right, now for something a bit more aggressive. Setup number 2, the panic flush. This one is absolutely high risk, high reward. We're talking about a situation where a stock just goes into a complete vertical free fall. The classic falling knife. It drops so fast, sometimes 5 to 20% in just a few seconds, that it actually triggers a trading halt. The play here is to buy the very instant it pauses. And here's just how fast it can happen. On the ticker SNDX, the stock just plummeted from $17 to below $16 as stop losses triggered a wave of panic selling. The entry was at $15.95, catching the absolute bottom of that flush.
The snapback was immediate, and the position was closed at $16.50 for a 50-cent per share gain. The total profit? About $500 in less than a minute. This requires lightning-fast reflexes. So our third setup is a contrarian play. It's called the reversal. This one's for a stock that's been weak. It's been selling off all day long. So instead of following the trend, we are trying to find the exact bottom and bet on a complete turnaround. The logic is that the short sellers will start to take their profits and maybe some value hunters will step in. The trigger we're looking for? The very first green candle after a long string of red ones.
And for the ultimate example of this, look no further than the unicorn reversal on GameStop, GME. I mean, after that historic drop from 480 all the way down to 120, a small starter position was taken near the low at 115 with a hard stop just below it. So the risk was incredibly small compared to the potential reward. When that reversal actually held, the position was added to, and that resulted in this mind-blowing swing from being down $12,000 to being up over $40,000 in just minutes.
Okay, look, getting into a trade is really only half the battle. How you manage the position after you get in, that is what truly separates the consistent winners from the people who keep losing.
And that brings us to a really critical distinction in habits. On one side, you have the winner's habit, averaging up. You buy a small starter position just to test the waters. If the price moves your way and confirms your idea is right, you add to it. You reward the winner. And on the other side, you have the loser's habit, averaging down. The stock was against you, so you buy more, hoping it'll come back. This is so dangerous, and it's exactly how people blow up their accounts.
So every single trade has two possible exits, and you should know them before you even get in. First, you have taking profit. The plan is to sell into strength as the stock is moving up. You can climb the ladder, selling off pieces at key psych levels. Then there's the other door, the bailout. That is your stop loss. If the stock breaks below the dip, your whole idea is broken. You cut the loss immediately. No holding, no hoping, you just get out. Just as important as knowing when to trade is knowing when not to trade. These are the red flags, the stay away signs. If there's breaking news that's causing a stock to drop, that is not a dip. That's a fundamental change and you stay away. If the stock is just stuck below VWAP, it's in bearish territory. If it's just chopping sideways, well, there's no momentum to trade. And of course, if you got technical issues like a bad internet connection, just stay on the sidelines. It's not worth it. And this leads us to the final and honestly, the most critical ingredient of all. It's not something you're going to find on any chart or in any indicator. It's all in your head. We're talking about the trader's discipline.
It really all comes down to this. On one side, you've got the trader. A trader executes rules. They accept losses as just a cost of doing business. They might focus on just one single good trade a day. On the other side, you have the gambler. They're chasing the adrenaline rush. They average down into losing positions. They overstay their welcome. You see, when a trade goes red, the trader accepts the small loss. The gambler just keeps throwing more money into a black hole.
So how do you keep yourself on the right side of that line? You use a checklist. Think of it like a pilot's pre-flight check before every single trade. Number 1, the scan. Does the stock actually have momentum? Is it above VWAP? 2, the setup. Are you clearly seeing one of those 3 patterns we just talked about? And 3, the risk. Is your stop loss clear? Is your potential reward at least double your risk? If you can't check all 3 of those boxes, you just don't trade. Simple as that.
And that brings us to the final command, the one rule that really trumps all the others. The absolute key to survival in this game is this. If the pattern is not clear, do not press the button. Seriously, patience is your single greatest asset.
So there you have it. We've walked through the entire playbook, the mindset, the tools, the setups, and the rules of engagement. The strategy itself is clear. The only question left is the discipline.